Welcome back. June non-farm payrolls came in lower than expected this morning, while May was revised lower as well. Let's bring in Hatzius, Goldman Sachs chief economist, talk about some of the numbers that we got. I mean, a lot of head scratching around the absence of a World Cup phenomenon, I guess, in leisure hospitality.
Yeah, we were surprised by that. So there were two special factors that we thought would boost this number. World Cup hiring was one. We didn't see it in those numbers. And then some seasonal stuff among teacher hiring, we also didn't see that. So the payroll number came in quite a bit weaker. You know, with that said, the payroll numbers have been extremely strong, really stronger than was plausible relative to other indicators. So I would view this as a bit more normalization. And we calculate an underlying job growth trend, which is based on the moving average of payrolls and also some weight on the household survey. That was running 130. As of the last report, it's now running at 74K.
Right. So it does feed your general view that we'll get rate cuts before hikes.
Yes, although I don't think you're going to get either of those anytime soon. So in the near term, the question is between, stay on hold or hike. Obviously, there are 9 participants in the FOMC who said they would want to hike potentially before the end of the year. So that's the debate. I think among the voting members, there's probably still a majority for staying on hold, though.
What do you make of the participation rate, and how much of that do you attribute to immigration?
It's been a little bit of a head scratcher. In particular, in this number, the participation rate plunged among 25 to 34-year-olds. I mean, there's not a lot of precedent for these kinds of moves month to month. The household survey is always noisy, but this is very, very large. I wonder whether there's some, major special factor there that maybe we haven't, we haven't really found yet. But it is, an aspect of the report that's definitely weaker.
There's chatter that young people are kind of dropping out, a little discouraged, right? Recent college grads, and then maybe older who, given the wealth effect and their 401ks, feel they don't need to work or search.
Yeah, it's just very concentrated in that one age group. And, what's so special about 25 to 34 versus, 34 to 35 to 44, something like that. Normally, if there's a story like that, you'd expect some moves that are similar in adjacent groups, but we're not really seeing that.
That pandemic cohort just hit 25, and that's it. They're the ones not working, but I'm kidding. But, I mean, obviously, it seems like the market is not really taking that much out of that, although it depresses the unemployment rate cosmetically below 4.2% unrounded. That, in theory, is what the Fed pays attention to. I mean, you could almost do, you could take whatever you want out of this if you were predisposed to be, more hawkish or dovish.
I would generally say the unemployment rate is what you're ultimately interested in if you're a Fed official, more so than the payroll numbers. That said, month-to-month moves in the unemployment rate can be noisy. It's based on a small survey, and especially when you have some oddities like this very concentrated participation drop, you probably want to take it with a grain of salt and say, we're probably still in the same kind of range for labor market utilization, which isn't too far from their estimate of full employment. They're 4.2%.
Right.
So I don't think that this is a reason to tighten for the Fed. They're going to be more focused on the inflation numbers. That debate is obviously still out there. Our view is, inflation is well above target at the moment, but there are some reasons for this that are probably going to fade. Tariff pass-through is one of them, and then the oil shock, which has obviously reversed to a significant degree. So our view is it's not necessary to hike, and we think that the majority of the FOMC is going to be in that camp too.